So what's a buy-to-let mortgage? Well, buy-to-let mortgages are for landlords who want to buy a property to rent it out. The rules around buy-to-let mortgages differ from those around regular residential mortgages. So who can get a buy-to-let mortgage? If you're planning to rent out your property, you will need a buy-to-let mortgage. You'll need to meet certain criteria and conditions to be eligible for one. The requirements differ from lender to lender and may include some of the following. So some buy-to-let lenders insist that you already own your own home, but not all of them have this requirement. You should have good credit and not stretch too much on other borrowings such as credit cards. You may have to provide evidence of employment income or earnings from self-employment, which is separate from rental earnings. This is typically around £25,000 a year, but again, not all lenders have this requirement. Some lenders have a maximum age at the end of the mortgage term, which is usually around 75 years of age, although there are lenders that lend beyond this. The loan to value must be a maximum of 80%, so you'll need a minimum of 20% deposit for a buy-to-let mortgage. You will, however, get better rates of interest with a bigger deposit. The amount you can borrow is dependent on whether or not you're a higher or lower rate taxpayer and on the monthly rental income that you're getting or are likely to get. Your rental income should cover between 125 and 145% of your mortgage repayments, typically using a stressed interest rate that is greater than the mortgage rate you obtain. Limited company buy-to-lets are treated slightly differently and require a specialist mortgage broker like myself to help avoid any costly mistakes. So how do buy-to-let mortgages work? Well, buy-to-let mortgages are a lot like ordinary mortgages, but with some key differences. The fees that lenders charge tend to be higher, interest rates are usually higher, and the minimum deposit is typically 25% of the property's value, although it can vary between 20 and 40%. Most buy-to-let mortgages are interest only. This means that you pay the interest only each month, but not the capital amount. At the end of the mortgage term, you need to repay the original loan in full from the sale of the buy-to-let property or from savings or any other investments that you might have. Buy-to-let mortgages are also available on a repayment basis for those that want to keep the property and own it outright at the end of the term. Most buy-to-let mortgage lending isn't regulated by the Financial Conduct Authority. There are some exceptions to this. For example, if you're going to let the property to a close family member, these are often referred to as consumer buy-to-let mortgages and are assessed according to the same strict affordability criteria as residential mortgages. So how much can you borrow for a buy-to-let mortgage? Well, the maximum that you can borrow is linked to the amount of rental income that you expect to receive. Your lender's going to want to be sure that the rental income from the property will cover the mortgage, plus a bit extra for security. Lenders usually need the rental income to be between 25 and 45% higher than your mortgage payment. If the rental valuation of the property isn't high enough, the loan to value the lender requires might be impacted, meaning that you'd need a larger deposit. To find out what your rent might be, talk to a local letting agent or check online to find out how much similar properties in the similar area are rented out for. It's a good idea to talk to a mortgage advisor before you take out a buy-to-let mortgage, as they'll help you choose the most suitable deal for you and take away all the uncertainty. If you're a high rate taxpayer, then you should also speak to a good property accountant who's going to advise you from a tax perspective.